What if your bank account kept growing while you slept, traveled, or did absolutely nothing? $3,500 every single month, from dividends. No alarm, no commute, no boss, just money arriving like clockwork every single month. Here's the brutal truth. Most people will trade 40 years of their life for a paycheck and still retire with nothing. That system is broken. But a small group of people discovered something different. They don't sell their time. They let money work for them, 24 hours a day. Dividends. A stream of income paid to you just for owning shares in great companies. The more you own, the more you earn, forever. $3,500 a month. That's the number. Rent, groceries, freedom. And today I'm showing you the fastest path to get there. I'm going to walk you through the exact portfolio blueprint, the specific funds, the deposit strategy, and the one mistake that slows everyone down. But first, there's one critical mistake almost every beginner makes, and I almost made it too. I'll tell you exactly what it is, right after this. So what exactly is a dividend? Simple. When you own stock in a company, that company shares its profits with you, cash, deposited directly to your account. Here's what makes it magical. You reinvest those dividends, your shares buy more shares, which pay more dividends. The snowball gets massive. Now the question everyone asks, how much money do I need to invest to get $3,500 a month? Let's do the math right now, and the answer might shock you. If you earn a 5% dividend yield, you need $840,000 invested. That sounds massive. But wait, there's a faster way. Stay with me. Most people chase high-yield funds at 7 or even 10%. But I'm going to show you a smarter two-stage strategy that builds wealth fast and generates income. Stage 1, explosive growth. Stage 2, convert to income. This two-stage approach is the fastest route to $3,500 a month, and most people never hear about it. Before I break down the exact funds, let me tell you the moment everything changed for me. I was sitting in a meeting that had absolutely nothing to do with my life goals, and I pulled out my phone and saw a dividend payment had just arrived. While I was stuck in that meeting, my investments were working. That was the moment I knew. So I promised myself, and I'm promising you right now, I'm going to lay out the exact step-by-step system. No fluff, no filler, just the fastest path to $3,500 a month. Alright, stage 1. This is the wealth building phase. Your mission here is simple. Grow your portfolio as fast as possible. You are not focused on income yet. You are focused on accumulation. Think of it like loading a cannon. The bigger the load, the bigger the blast when you fire. The best vehicle for stage 1 is a total market index fund. Think VTI, the Vanguard Total Stock Market ETF. This one fund gives you exposure to over 3,500 companies. It's grown an average of 10 to 11% per year over the last 30 years. You're not guessing. You're owning everything. Here's something that most financial content glosses over. Fees are silent killers. A 1% annual fee sounds tiny, but over 30 years that fee eats 28% of your total returns. VTI charges just 0.03%, virtually nothing. This is why fund selection is not trivial. Now here's the question I get most often. What if I can only invest a little? Perfect. Start with $25 a week. That's $100 a month, automated. Set it and forget it. Consistency beats amount every single time in the early stages. Watch what happens to that $25 per week over time. In 10 years, at a 10% average return, you're sitting at roughly $22,000. In 20 years, nearly $78,000. In 30 years, almost $240,000. And that's starting from zero with just $25 a week. The math is not lying to you. But $25 is just the floor. Every time you get a raise, a bonus, or cut an expense, put that extra money to work. If you push to $200 a week, your 20-year total jumps to over $600,000. The contributions are the accelerator pedal. The market is the engine. Remember that mistake I promised to tell you about? Here it is. Most beginners skip stage 1 entirely. They hear dividends and immediately pour everything into high-yield income funds. Before they've built any real wealth, it's like trying to harvest a crop you never planted. You must build first, then collect. So when do you make the switch from growth to income? There are 2 triggers. First, when your portfolio hits your income target, we'll calculate that in a moment. Second, when you are within 5 to 7 years of wanting to live off dividends. Either trigger works. Hit 1, flip the switch. Welcome to stage 2. This is where the magic you've been building finally pays you. You start shifting your portfolio from pure growth funds into high-quality dividend-paying funds. Now your money stops growing as a pile and starts flowing as income. For stage 2, the gold standard is SCHD. The Schwab U.S. Dividend Equity ETF. It holds 100 of the highest quality dividend-paying companies in America. It yields around 3.5 to 4% annually. But here's the hidden superpower. SCHD's dividend grows by roughly 10 to 12% per year. Your income increases automatically. Let me show you why dividend growth changes everything. If SCHD's dividend grows 11% per year, your $3,500 monthly payment becomes $5,900 in 5 years, without adding a single dollar. In 10 years, it becomes $9,900 a month. You're getting a raise every year, automatically, forever. VTI for growth, SCHD for quality income. But there's a third fund, a controversial one, that supercharges your monthly cash flow dramatically. Some people love it, some people hate it. I'm going to show you both sides in just a moment. That third fund is JEPI, the JP Morgan Equity Premium Income ETF. It uses a strategy called covered calls to generate a yield of 7 to 9% annually. That means on a $500,000 portfolio, JEPI alone could pay you $2,900 to $3,750 per month. The trade-off? You sacrifice some long-term growth. That's why it belongs in Stage 2, not Stage 1. So here's how you combine all three. In Stage 1, 100% VTI. In Stage 2, roughly 40% SCHD, 40% JEPI, and 20% VTI to maintain some growth exposure. This combination delivers income now while still growing your purchasing power over time. Now let's calculate your number. Take your monthly income goal, $3,500. Multiply by 12 to get your annual need, $42,000. Now divide by your expected yield. If your Stage 2 portfolio yields 6% combined, you need $700,000 invested. That is your North Star number. So how long does it take to reach $700,000? It depends almost entirely on how much you invest each month. At $500 a month, you're looking at roughly 26 years. At $1,000 a month, it drops to about 19 years. At $2,000 a month, you can get there in just 14 years. The math favors the aggressive saver. Here's a move most beginners skip that will save you tens of thousands. Use tax-advantaged accounts first. Max your Roth IRA, $7,000 per year. Max your 401k if you have one. Dividends inside these accounts grow tax-free or tax-deferred. The government is not your partner. Don't let them eat your gains. Now let's talk about DRIP, dividend reinvestment plans. When dividends are paid, instead of withdrawing the cash, you automatically reinvest them into more shares. More shares means more dividends next quarter. It's a self-feeding loop. Most brokerages let you activate DRIP with a single click. Here's proof of DRIP's power. $100,000 in VTI without DRIP over 20 years at 10% grows to about $672,000. The same $100,000 with DRIP enabled grows to $732,000. That's $60,000 in extra wealth from a single click. The machine is always working. Where do you actually buy these funds? For U.S. investors, Fidelity, Vanguard, and Schwab are the top three, all commission-free on ETF trades. Fidelity has excellent tools and no account minimums. Schwab is ideal if you want SCHD directly from the issuer. Either works. The best brokerage is the one you'll actually use consistently. The single most important behavior for dividend investors: automate everything. Set up an automatic transfer from your checking account to your brokerage every payday. Set up automatic investing into your chosen ETFs. Remove all decisions. Remove all emotion. The investor who automates beats the investor who tries to time the market every single time. Now I want to talk about something that trips up almost every new investor. Market crashes. When the market drops 30%, most people panic and sell. But for a dividend investor, a crash is actually a sale. You're buying the same great companies at a 30% discount. Your automated contributions keep buying. Your DRIP keeps reinvesting. The crash makes you richer if you hold. This strategy has a name: dollar cost averaging. You invest a fixed amount on a fixed schedule, regardless of price. When prices are high, you buy fewer shares. When prices are low, you buy more. Over time, your average cost per share drops below the average market price. It's a built-in edge. Let's get real for a moment. What does $3,500 a month actually mean for your life? Rent for most of America covered. Groceries, utilities, transportation handled. Plus a reasonable budget for entertainment and savings. You're not on a yacht, but you are completely unchained from a job you don't love. That is freedom. Once your dividends cover your baseline expenses, something profound shifts. You're no longer working for survival, you're working by choice. Every decision you make from this point forward is about desire, not desperation. You can travel, you can pursue passion projects, you can simply do nothing, all valid, all yours. I know what some of you are thinking. I'm already in my 40s or 50s. Did I miss the boat? No, you did not. Later starters often have higher incomes, lower expenses, and better discipline. You can compress the timeline dramatically by investing more aggressively. Age is not a disqualifier. Inaction is. Another objection. But I have debt. Here's the rule I follow. If your debt interest rate is above 7%, pay it down aggressively first. Below 7%, invest alongside the debt paydown. Why 7%? Because the market historically returns 10% annually. Above 7% debt is a guaranteed negative return that beats the market average. There's a risk in dividend investing that almost nobody talks about in beginner content. Sequence of returns risk. If the market crashes right when you start withdrawing dividends, you might have to sell shares at a low to cover expenses. This can permanently shrink your portfolio. The solution: keep 12 to 18 months of expenses in cash when you enter stage 2. That 12 to 18-month cash buffer is your emergency runway. If dividends are temporarily cut or markets drop, you live on cash while the portfolio recovers. This is held in a high-yield savings account, earning 4 to 5% while it waits. Your buffer works even while it protects. One more layer of optimization: international diversification. The U.S. market has been dominant, but it won't always be. Adding a small allocation to VXUS, the Vanguard Total International Stock ETF, gives you exposure to developed and emerging markets worldwide. Roughly 20% international is a common recommendation. Let me show you the complete advanced stage 2 portfolio. 35% SCHD for quality U.S. dividend growth, 30% JEPI for high monthly income, 15% VTI to maintain growth exposure, 20% VXUS for global diversification. Combined yield approximately 5.5 to 6.5%. On $700,000, that's $3,200 to $3,800 per month, right in our target zone. Once per year, rebalance. Some holdings will grow faster than others and drift from your target allocation. Rebalancing means selling what's grown too large and buying what's lagged. This locks in gains systematically and keeps your risk level intentional. Set a calendar reminder, 1 hour per year. That's all it takes. Let's talk taxes. Qualified dividends, the type paid by most ETFs including SCHD and JEPI, are taxed at capital gains rates, 0%, 15%, or 20% depending on your income. If your dividend income is your only income at $42,000 per year, many investors in that bracket pay zero federal tax on qualified dividends. The tax code rewards passive income. Inside a Roth IRA, qualified dividends grow and are withdrawn completely tax-free. Let that sink in. $3,500 a month, tax-free, your effective tax rate on that income 0. This is why maxing your Roth IRA every year, especially early, is one of the most powerful financial moves in existence. Let me share a real story. A 32-year-old nurse began investing $800 a month into VTI in 2014 inside a Roth IRA. By 2024, her portfolio had grown to $230,000. She switched 60% to SCHD and JEPI. Her annual dividend income, $11,000. And growing. She hasn't quit her job yet. But she could cover 3 months of expenses with dividends alone. The freedom is building. Here's the deepest truth I can give you. The biggest barrier to financial freedom is not money. It's identity. You have to stop seeing yourself as someone who trades time for money and start seeing yourself as an owner. Owners build assets. Assets pay them. The shift from earner to owner is the fundamental transformation. People spend years researching the perfect fund, the perfect time to start, the perfect amount. Here is the truth. Perfection is the enemy of freedom. The best portfolio is the one you actually build. The best time to start was yesterday. The second best time is right now. Open the account tonight. Buy your first share tomorrow. Let me wrap the math together one final time. You need $700,000 to generate $3,500 per month at 6% yield. Invest $1,000 per month into VTI with DRIP in a Roth IRA. At 10% average returns, you hit $700,000 in approximately 19 years. Then shift to SCHD and JEPI. Collect $3,500 every month for life. That is the complete system. 19 years to never work again. And here's what most people don't think about. What happens when you hit the goal? Your dividends keep growing. At 11% annual dividend growth, your $3,500 becomes $10,000 per month in 10 years without changing anything. You don't have to stop. You don't have to adjust. You just live, and the system keeps accelerating. There's one more layer worth considering. A dividend portfolio, unlike a paycheck, is an asset you can pass on. Your portfolio can outlive you, generating income for your children and their children. The paycheck dies when you do. The portfolio does not. You are not just building freedom for yourself, you are building generational wealth. Here's your 7-day action plan. Day 1, open a Roth IRA at Fidelity or Schwab. Day 2, set up automatic transfer of whatever amount you can. Day 3, buy your first shares of VTI. Day 4, enable DRIP. Day 5, set a calendar reminder to rebalance annually. Days 6 and 7, share this system with one person who needs to hear it. That's it. 7 days, freedom has a start date. Imagine it's 5 years from now. Your portfolio is growing, your dividends are compounding, and one morning, just like that nurse, just like the moment in that meeting, you check your phone and realize you don't have to work today, not because you're sick, not because it's a holiday, because your money said so. That moment is available to you, starting now. If this gave you a clear path, smash that like button and subscribe. Every week I break down exactly how to build wealth through dividends, index funds, and financial freedom systems. And if you want to go deeper, check out the video right here on how to build your first $100,000. That's where the real momentum begins. See you there.